question with regard to the prior learning unit or question 2 before we proceed to study number 9?
All good, thanks.
Okay, then it means now we can proceed to learning unit number 9. The learning number 9 will be dealing with the treatment of preference shares. So in this case, now our group, they have preference shares issued to other people outside of the group. So it either subsidiary issued preference shares to the public or parent issued preference shares to the public. So now we want to check how do you make a consolidations of those matter? Because in the prior unit number 8, we were dealing with the ordinary dividend, which the ordinary dividend mostly they declared after the preference shares have been paid to their shareholders. So in terms of the dividends, if we are making a profit, we're going to pay the dividends to the preference shares. So whatever remain out of that profit, now it can be paid to the ordinary shareholders. So if you turn to page 203 of the study guide, there's a paragraph for introduction. And then it starts where they say in learning number 8, we discuss the treatment of dividends where subsidiary share capital consists of ordinary share capital only. That was the case. Now things are turning. The subsidiary capital, it may have either ordinary capital alone, or it can have ordinary capital and also preference share capital. So in this learning unit, we'll deal with the treatment of preference share capital and the preference dividends. Preference shares carry a fixed dividend percentage. So normally when they issue preference shares, they will tell you that 8% preference shares are issued at 10,000 Rand or 25% preference shares are issued at 25,000. So that fixed percentage is the one which is going to be used to calculate the preference dividends. Preference shares carry a fixed dividend percentage. When adequate profits are available, these shares have a preference right to dividends. Preference shares can only exist when another class of shares, general ordinary shares, exist. So the preference shares can enjoy certain preferential rights in comparison to other shares. So in this situation, there is no way a company can have preference shares alone. There is no way. It can only have ordinary shares alone or a mix of ordinary shares and preference shares. So the primary issue of preference shares lies with the ordinary shares. So you must first have the ordinary shares, then after we decide if you want to have the preference shares. So we can summarize our preferential right as follows. 1, for the purpose of the following discussion, the preferential rights respect of the dividends are probably the most important right attached to preference shares. This right is normally expressed as a percentage of the value of the share, like I said. For example, 9% of preference shares with issued with a value of 400,000. So in this case, the company issued 400,000 preference shares, which they have a percentage right of 9%. So when we declare the dividend, we're going to say the 9% multiplied by the 400,000. Therefore, the dividend will be 36,000. If the subsidiary is liquidated, the preference owners will receive a maximum amount of the 400,000. So suppose in this case, it was consolidations, and then it happened that the subsidiary get liquidated. So all the preference share owners will able to get their money back of the 400,000 before the remaining can be distributed to other creditors. Where subsidiary had issued preference shares, these shares have a preferential claim to the profit of the company, while the balance is attributable to the ordinary owners. So in this case, if you have a profit realized from our operation of the business, if you want to declare the dividend, we're going to first start with the preference shareholders. So whatever amount remain after the declaration of the dividend for preference shareholders, it can be attributable to the ordinary dividends. As in the case of ordinary shares, preference owners cannot legally lay claim to their shares of the profit before a company has declared the preference dividend. If the preference shares are cumulative, ordinary owners may receive no dividend in the current reporting period unless a preference dividend is declared. We can classify the preference shares as follows with regard to the dividends. The non-cumulative, the owners are not entitled to the payment of area dividends. So if the preference dividends are not cumulative. So if the current year of 2021, we didn't declare any dividends, when we declare the dividends in 2022, we're not going to pay the one for 2021 because they are not cumulative. We'll only focus on the year of 2022. Then the cumulative dividends. If no dividends is declared in the specific reporting period, there is a cumulative preferential right, which is the right to have the preference to the area and the current preference dividends before a dividend may be declared on any other class of the shares on the first subsequent dividend declaration. Even if the company does not declare a formal dividend to the preference owners, a dividend will accrue and become payable based on the terms of the preference shares. So with regard to the cumulative, if we didn't declare the dividend in the year 2020, and then we have a adequate profit to declare the dividend in the year 2021. So when we pay our dividends, we're going to pay the one for 2020 first, and also pay the one for 2021, and then whatever remain, it will be used to pay for the ordinary dividend. If there is no available profit to pay for ordinary dividends, so it means you can only pay the preference shareholders, which will pay the one for 2020 and the one for 2021. Normally, cumulative preference dividends to dividends are normally specifically prescribed in the designation of the shares. For example, 8% cumulative preference shares. Where it is not specifically stipulated, it is assumed that preference shares are cumulative. So if they don't say anything about the cumulative, non-cumulative, they just say preference shares, we will assume that these shares, they will be cumulative. Participating preference shares share in the profits of a company after the payment of the preference dividend, while the convertible preference shares are convertible to ordinary at a specific date in future. So the participating, they will get a dividend after we paid the preference one. Then the convertible normally is not in the form of dividend. They don't get the dividend in most cases because they are shares, they will be converted into the ordinary shares in the future. So we can issue the convertible preference shares today, and then you said they will be converted after 5 years, unless at the discretion of the issuer. If the issuer said, no, I don't want to convert them in 5 years, I want to convert them in the next 2 years, so that will be the discretion. So the minute that they make a discretion to convert those dividends, then we'll convert them into the ordinary shares, and then from then they will be entitled to, they will be the ordinary shareholders. Although a company may not buy its own shares, it may buy back or redeem preference shares at a predetermined price after a specific period. Where preference shares are held in a subsidiary, this affects the calculation of the non-controlling interest in the consolidated statement of profit and loss and other comprehensive income and the statement of financial position. By the time you have completed this learning, you should have a clear understanding of the concept. Liability versus the equity. When the issuer of a preference shares has a contractual obligation to deliver cash or a financial instrument to the holder of the preference shares, or does not have an unconditional right to avoid delivering cash or a financial asset to settle the contractual obligation, the obligation will miss the definition of a financial liability. So this part, you'll know it more when you'll be doing with the third level, especially those one who will be able to do the FAC in the third level, then they'll be able to understand the part of the financial liability versus financial asset and versus the financial instrument. So that part mostly dwell in the FAC at third level. Likewise, if the issuer of a preference shares does not have an unconditional right to avoid the delivery of cash or financial assets to settle the contractual obligation, that obligation will miss the definition of an equity instrument. An equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all the liabilities. In FAC 2602, we do not classify financial instrument. It's therefore assumed that the preference shares that provide for the mandatory redemption by the issuer of the shares for a fixed amount at a fixed future date, where the payment of the dividend are compulsory, are classified as financial liabilities. So for the purpose of this module, we'll be dealing more with the financial liabilities. So we will assume that our group, they have a financial liability towards their shareholders to pay the dividends at a specific date. Such an investment is not a consolidated. In all other instances, preference shares are assumed to be non-redeemable and therefore regarded as an equity instrument. In FAC2602, we assume that all preference shares are classified as equity and hence consolidated when it's applicable. Then the paragraph 9.2, we are dealing with the procedures if the subsidiary capital includes the preference shares. So in the prior learning units, all of them from 1 to 8, we were only focusing on the ordinary shares. So now we have a situation whereby our subsidiary is issued both the ordinary shares and also issued the preference shares. So me as the person who acquired my subsidiary, I want to know how will I acquire him based take into account that he have both two classification of shares, the preference, the preference shares versus the ordinary shares. Since the parent percentage interest is in the ordinary share capital of the subsidiary, it is not necessarily the same as its percentage interest in the preference share capital. So in this case, we may find that I acquired 70% of shares in the ordinary, but I acquired another 60% shares in the preference. So you can see that there are two votings. There's 70% voting rights in terms of ordinary, then there's 60% votings in terms of the preference shares. So for the purpose of that situation, we are recommended that you must draft two analysis of shareholders. So now you must note, when you see that the company had acquired the ordinary shares and also acquired the preference shares. So when you answer the question, you must make sure that now you draft two analysis of shareholders. The first one will be for the ordinary shares, while the second one will be for the preference shares. So let's check example on page 205. We are given the abridged statement of financial position, statement of profit and loss, and the statement of changes in equity, which is on page 206. So all of those, they have the values. So when we check the statement of financial position, especially on the equity and the liability part, you see that there is a share capital, ordinary shares of 200,000 divided by 100,000, whereby P Limited have 200,000 shares issued and S Limited have 100,000 shares issued. And then the share capital of 10% preference shares, which consists of 50,000 shares. P Limited does not have any preference shares issued in his books. However, S have 50,000 shares issued in his books. So it means me as P, I'm acquiring the shares in S Limited in the context of ordinary. However, S Limited have two types of capital. His capital is structured into two components, the ordinary and the fixed. So since I'm acquiring him, I also have to acquire the portion of the preference shares. So when we check on the asset part, the way I acquired the company of S Limited, I acquired in the form of 75,000 ordinary shares, which its cost price is 120,000. So I paid 120,000 in order to acquire 70,000 shares, 75,000 shares in S Limited. And again, I paid 25,000 to acquire 20,000 preference shares issued in the books of S Limited. So now we must determine our voting rights. Our voting rights in terms of the ordinary shares, it will be the 75,000 divided by 100,000, which will give us the 75% voting rights in S Limited. And then in terms of the preference shares, we will say the 20,000 divided by the 50,000 shares issued by S Limited, which will now give us the 40%. So it means in terms of the consolidations, I acquired only 40% of the preference shares in S Limited. So whatever remaining 60% will now consist of the NCI. But for the consolidation purposes, we only regard the other company as a subsidiary if we owe greater than 51% of his shares in terms of the ordinary shares. We don't care much about the preference shares. We only focus more on the ordinary shares in order to determine whether that person will be a subsidiary or not a subsidiary. So if we acquire more than 51%, then that person qualified to be our subsidiary. Then we have the additional information on page 206. Number 1, where we told that P Limited acquired its its shareholding in S Limited on 1 January 2005. That is the date of acquisition, on which date the S Limited retained earnings was 90,000. Then consider the carrying amount of the assets and the liabilities of S Limited to be equal to the fair value thereof at the date of acquisition, except for the land of S, which was valued at 120,000. So on the date of acquisition, all other assets were equal to their fair values, except the land, which was equal to the 120,000 on the date of acquisition. But however, S Limited on that day, he recorded his land at the value of 80,000. So, but when we acquired, we found out that the land is no longer valuing 80,000. Instead, it's valuing 120,000. And on top of that, there were no entries made in the books of the subsidiary. So S Limited didn't account that revaluation of land for 120,000. So it means now when we consolidate, we must also make sure that we account for that revaluation of land. So no entries have been made in the books of subsidiary. No purchases or sale of land and building have taken place subsequently. Number 2, on 1 April 2007, S Limited has been buying some of its inventory from P Limited at the cost price plus 25%. On 31 December 2007, the inventory of S Limited included in inventories to the value of 10,000 that had been purchased from P Limited. Inventory that P Limited invoiced at 3,000 were in transit to S Limited on 31 December. So in this case, parent is selling to subsidiary, is selling the inventory to the subsidiary. So it means that part of the profit will only affect our consolidation because parent will be the one realizing the profit. So the profit will only affect our consolidation. The profit will not affect any way the analyzed shareholders of the subsidiary because subsidiary is not the one making the profit. So required, it says, draft the consolidated annual financial statement of P Limited Group for the year ended 31 December 2007 in compliance with the requirements of IFRS. Any taxation on unrealized profit. So as usual, I'm gonna share my Excel so that we can able to treat the question together. Just hold on while I'm going to the Excel. Okay, please notify me if you can able to see my Excel so that we can proceed.
It's displaying.
Okay. Now let's work out on the example. So for the purpose of this module, actually there are just 3 learning units that you need to understand. If you know these 3 learning units, then you will be in a good condition to pass the module. The first learning unit is number 7, then followed by number 9, and then from there will be the topic of cash flow. So if you know all these 3, then it's just a repetition of these exercises. Because if you can see now, we are already dealing with the issues of the inventory, which is they come from the learning number 7. So now let's tackle the question. We're gonna first start with the analysis of shareholders, which the analysis of shareholders, it will be the one of the subsidiary, which is S Limited. So in this case, because we are dealing with the ordinary versus the preference, we have to draft 2 analysis of shareholders. So we're gonna start with the one for ordinary shares. So it's gonna have so it will be the one for ordinary shares. And then we have our columns as usual. which it will be the total. We have our at, we have the since, then we have the NCI. Then at the acquisition as per adjustment number 1, the share capital, when we acquire him, his share capital was, it was sitting on 100,000 as per the abridged statement of financial position versus the statement of change in equity. Based on the percentage, we acquired 75% shares. Then it means here it will be the 75,000. And then the remaining 25 will go to the NCI. Then the retained earnings on the date of acquisition, as per adjustment number 1, they said the retained earnings was 9,000 on the date of acquisition. That's 9,000. Then we do the 75% of each, which it will sit on 6750, and then the remaining balance will constitute the NCI. Then on the same date of acquisition, we told that his land, it was now valued 120,000. However, there were no record made on it. So first, they're gonna be, in terms of the journal, we have to have the journal where we account the revaluation of the land, but we're still gonna do that journal. We're gonna evaluate the land. Then after evaluating the land, it means now the land will be sitting at 120. So now we want to know that if this land was sitting on 120, before it became 120, how much was it? Which it was 80,000. So the revaluation of land plus, now it will be the 120 minus 80,000, because initially was valuing 80,000. So it means we have a revaluation surplus of 40,000, and then at the 75% of each should be 30, and then the balance of 10,000 will constitute the NCI. And then we do we check how much did we pay as the parent. We paid an amount equal the 120,000 to acquire the ordinary shares. So the consideration given, is 120,000. It's 120. Let's see the consideration given. For 75,000 ordinary shares is 120. Now we have to check if we have any goodwill or not. So we're gonna say 120 minus 30 minus 6750 minus the 75,000. 30 minus 6750, then minus 75. So it tells us that we have an 8,250, which must be represented as goodwill. So it's 8,250 is our goodwill. So this in total, they were sitting on they were sitting on 111,750. So 111, when you say 120 minus 11750, it's situated at 8250, which this will be goodwill. Then we proceed further. Our acquisition date was on 1 January. So from 1 January to be since. So the since acquisition to the beginning of the current year. So in this case, we're gonna have the retained earnings. So the retained earnings in the books of subsidiary as shown in the statement of consolidation, it says the retained earnings, it was sitting on 14,000. So we're gonna say the 14,000 we less the 9,000 at the date of acquisition. Then we have an amount retained earning. Then we have an amount of 5,000. Then we do our percentage, which will be 3,750, and then the NCI will be the 1,250. Then we go to the current year. On the current year, the profit calculated from the subsidiary as seen on page 205. So the profit for subsidiary is 38,000. Then the amount equal to the 75% will be 28,500. And then the one for NCI will be the 9,500. Therefore, now, on the statement of changes in equity, if you check under the retained earnings column of S Limited, they mention that the dividend paid is on the preference is 5,000. So the different dividend paid of 5,000, we realized a profit of 38,000. So it means we have enough cash that can be used to pay the preference dividends. So we will say preference dividends which we want to pay the preference dividends of how much is that it was the provision made. Now we're gonna finalize it. It was 5,000. So we pay 5,000 here, which it will be in the brackets. And then the difference we multiply by the 750. 75%, which it will be the 3,750. And then here it will be minus 1,250, which is the difference. So this is the preference dividend based on the profit available. And based on the profit available, then since when you say 38 minus 5, there's still much profit left of 33,000. So now, again, on the retained earnings of S Limited in the column for S, they say we paid the ordinary dividends for 10,000. So we still sit with the profit with 83 left. So it means we can also pay the ordinary dividends. So ordinary dividends are paid at 10,000. So the 75% will be 7,500, which will be the minus also. And then the minus 2.5. So this will represent the ordinary dividend. So it will be the ordinary dividend after payment of preference shareholders. It's mandatory that first you pay the preference shareholders, then the remaining must be utilized for the ordinary dividend. If there is no money available to pay for ordinary dividends, so it means in that case, the ordinary dividend won't be paid. So we can do the totals. Which will sit on 185, 250, 21,000, after taking into account the whole column. And then here we'll sit on the 44, 250. So up to so far, is there any question with regard to this analysis of shareholders, especially towards the context of the preference shares? YV?
No questions. I'm all good. Thank you.
Mary?
So far, so good, sir. Thanks.
Memory?
So far, so good.
And the last, Tandaka?
Good, thank you, Mr. Miller.
Okay, then we proceed further. Now we're going to do the analysis of shareholders. The analysis of shareholders for the preference shares, because now we had noted that we, as the parent, we acquired two classes of shares in our subsidiary, because our subsidiary was issued two types of shares, the preference and the ordinary. So now we do another analysis, which will be based on the preference shares. Preference. Okay, then it will be the total. It will be the at ins NCI. So now refer back to our same page 205. The share capital in respect of the preference shares of S Limited was sitting at 50,000 shares. And we, as the parent, we paid an amount of 25,000 in order to acquire 20,000 preference shares in S. So now it means in terms of the percentages, which will come as, let me put one here. It will be, we'll say, the 25,000, the 20,000 divided by the 50,000 shares issued by S, which equal the 40%. So it means in terms of the consolidations, we only own 30% of the rights in him. So here it will be the 40%. Then we can start calculating now. The preference share capital. So the share capital will be the share capital as shown in his book of S, it was sitting at 50,000. So on top of that 50,000, we acquired only 40%. So the 50 times 0.4, which equals the 20,000. So we are only entitled to is 20,000. So the remaining 30, it must go to the NCI. So on our side, there is no anything that needs to be taken into account, so we can have our totals. So which our total will be the 20,000 here. And then here will be 30.
Is goodwill not applicable to preference shares?
No, I'm still going. Wait, I'm not yet done. It will still be applicable. I'm not yet done here. I just want to fix this. Then we check the consideration paid. Here there will be a consideration. Which he paid as per amount shown in the SFP. He paid an amount of 25,000 on cost. So 25,000 is the amount paid. So the consideration given is 25,000. So 25,000 minus our 20,000. So it means to represent the goodwill. So there's a goodwill of 5,000. Then we can proceed. So since acquisition, there was nothing happened during our since acquisition. It will be, so in this case, it will be since acquisition until the end of the current year. Acquisition. And so on our current year, we have the so you saw that we declare the dividends here using the profit, the yellow one. So this amount in the yellow one, we're gonna transfer the 5,000 towards our analysis of the preference shares. So this is the 5,000 to be transferred. Let me make it in green. So we take that 5,000, we put it here, which it will be the attributable to the profits. So the amount attributed to the profit is the 5,000 in green. So it will be the 5,000 here. But now we are no longer going to use the 3750 and the 1250 because based on the percentage, here we're only entitled to the 40%. So we're going to say our 5,000 we multiply by 40%. Which should give us the 2,000 on the since. And then the remaining 3,000 will go to this side as the difference. Then this is this green portion. So the preference dividends attributable to the profits. So whatever I write on the right, I just want is just for elaboration purposes. It's not what you have to write in the book. I'm just giving you to understand where does this amount comes from. Then when you check from the your pre-adjustment statement of financial position, they told us that the share capital for the preference shares consists of 10,000 preference shares at 50,000, which equal 50,000 rand. So you're gonna say the 50,000 in rand multiplied by 10%. But sometimes they can say the share capital consists of 10% preference shares of 50,000 shares. However, the amount there, instead of being 50, it become 100,000 or it become 150,000 or 200,000. So the amount multiplied by a percentage, it will be the preference shares declared. So here you're gonna say we have the preference dividend. So the preference dividend is the amount in the value, which the value was 50,000 in rands. So it comes from the 50,000 in rand multiplied by the percentage in interest, which is 10%. So don't think they used the 50,000 in number of preference shares. No, we use the value. Please note that we use the value. So here, the 50,000 value times 10%, it's gonna give us the same 5,000. Then it will be the 2,000 and the 3,000. However, this one, they will sit in the minus because they are the dividends declared. So it's just to offset whatever happened in the terms of the provision, because the one on top, it was provision that if we make a profit, we'll pay the dividends. Which they did make the profit, now they are paying the dividends. Then we can close our analysis. Which is closure, it will be the 55,000. So the 55,000 then counted the result, there was 5,000 goodwill here. It will be 55,000. And then we have 0, because this they offset each other. And then here we'll have the 30,000. Any question up to so far?
Mr. Molepo,
Yes,
what
Tandeka.
happens in case of no profit for the year? Let's say it happens there isn't enough profit to use that treated.
To declare the dividend. So let's say now, I think you're still gonna see it in the future, but I'm just explaining it. It will be one of the example. Let's say the profit sitting here, it was, let's say 2,500. So since there is no dividend, so our preference dividends here, it was gonna be nil. We are not gonna declare any dividends because there is not enough profit to declare the dividend. So our preference dividend was gonna be nil, and everything here will be nil. The same applies to this side. We are not gonna have these transactions. It will be nil, 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 because there was no dividend declared. So it means these dividends now they will become a liability. So in our consolidated statement of financial position, we have to show that we still have a liability to declare the dividends of 5,000, which came as a result of the 50,000 multiplied by the 10%. So it's a liability, it's a dividend to be declared in the future. So we know that we still own our preference shareholders an amount equal to the value of 5,000. Are you well answered?
Yes, thank you.
You will see it more. I think it will be in. Let me check. You'll see it more on example 2. On example 2 is where you encounter that kind of a situation. Maybe also example 3. So if there is no enough profit, so if you declare them at the end, they were gonna be a liability. So you have to show that on your statement of financial position, you have a liability equal to the amount of the dividends that they were not yet declared. So, but we will dwell more on it when we'll be dealing with the question. So now let's proceed further. So now we're gonna account the journals. So the journals, I'm gonna only do like the journals which they'll be complicated, the new ones mostly. The one which is just a repetition is since we started learning number one until now. I'm not gonna repeat them. Like the one of the share capital, the retained earnings, the dividend payable or dividend received. We have been dealing with those ones since from learning number one. So I'm not gonna repeat those journals. It just is same repetition. I will only be focusing on the new journals that they were not part of the prior study units. Are we fine there? Wavy?
Yes, I'm following. Thank you.
Okay. Mary, Memory, and Tandaga, I guess you're also following. So let's start with the journal for the land, because there was a land revalued. However, that land was not accounted for. So remember the pro forma, here we do the journal to record whatever. This is like the journal before, what we call, before the consolidations. So we do the journal before the consolidations, then after there will be the journal after the consolidation. So the journal after consolidation is called a pro forma one. So also note that if there are any transactions which have not yet been recorded, you have to account them first, and then after do your pro forma journals.
Sorry, can you repeat that again, please?
Okay. When you are dealing with the question regarding the consolidations, you read your information. So when you read the adjustment, you will see that there is a whatever happened. However, whatever that happened has not yet been recorded or has not yet been accounted in the books. So you first record it in your journals. Then after you do the consolidations, because the consolidations comes as a result of everything taken into account.
Okay, now I'm following. Thank you.
So let me deviate a little bit. The basis of answering this question of the consolidations, mostly first, it will be your analysis. And then two will be the journal before consolidations. And then from there, three will be your consolidations journal, which is, we call them pro forma journals. So the pro forma journals, it will be either to eliminate or it's either to transfer into consolidations. So if something is not being eliminated, it means we're going to take it into the books. So we are carrying it into the consolidations. Then from there, four, you do consolidations statements. So whatever, if the question says draft the consolidated statement for the year ended, whatever, and then they say 60 marks, just know that their 60 marks comes from here, because in the prior years, they used to ask just two questions. Question one being 60 or 65 or 70, then question two being the 30 marks, which the 30 marks will come from the cash flow. So the smaller marks, mostly they come from the cash flow, then the huge marks, they come from the consolidations. So this is the basis to answer your consolidations in any question that may arise. Okay, then let's proceed. Now is the journal to record any missing items, the one which were not accounted for. So when you check from the page 206, adjustment number 1, the land and building revaluation was not accounted for. So we need to record it. And then again, there was the inventory in transit, which was not accounted for. They say on 31 December, the inventory of S Limited include inventory to the value of 10,000 that had been purchased from P, and inventory that P invoiced at 3,000 were in transit. So that inventory which was in transit is not yet accounted for in the books of S Limited. So in the book of S Limited, you need to account for those things. So this journal, it will be the journal for S. So it will be S Limited. Then it's journal for the year ended 31 December. Yes, 31 December 2007. So it's also usual. We've got debit, got credit. Then we record the revaluation part. So when we record the revaluation, it's gonna increases our land. So our land increase on which side? On the debit side. So we have land, and then it's what causes our land to increase is the revaluation. So it increased by how much? Which it was the 120 minus 80, which is 40. So in most cases, you will be lucky if they say they don't want the narrations. But if they want the narration, so you have to tell us what was the main purpose of you doing this transaction, or recording the revaluation of land or evaluation of land at the date of acquisition. So in your own case, even though they say the narration are not required, it's imperative for you to understand what is the purpose of you making that journal. Why are you recording that journal? What do you want to achieve? So if you can know that what you want to achieve by doing this journal, then you won't get it wrong, because you know that here my purpose was to revalue the land, and the land increased on the debit side. And what caused the land to increase? It was the revaluation. So my revaluation also, as part of the retained earnings, they increase on the credit side. It's important to know the purpose of why you're recording this journal. What do you want to achieve by recording the journal? Then we go further. Now we were told that there was inventory in transit. So when S Limited was about to close his books, he thought he have only inventory to the value of 10,000. And then he get an invoice that he get an invoice that there was an inventory for 3,000, which is on transit, is still coming on in his premises. So now, as you already have the invoice now, as the end of the year, he have to account that inventory. That okay, I'm also having an inventory of 3,000, so my inventory need to increase from 10,000 to 13,000. So you're gonna record the inventory, which is increased on the debit side. Which is increased by 3,000. Now, here comes the trick. When you check your example or a question on the statement of financial position, P Limited have a current account in S Limited, and his current account in S Limited is sitting on 8,000, while S Limited have a current account in P Limited, which is sitting at 5,000. So we need to ensure that our current accounts as parent and subsidiary, they become equal. So since P Limited have the highest current account, we need to also increase the current account of S Limited from the 5,000. We need to increase the current account in P Limited, the one for S, from the 5,000 to 8,000. So in order to achieve that, we're going to utilize that inventory. So whatever inventory that S buy from me as P, instead of accounting it, instead of S to give me cash, I'm gonna use that 3,000 to increase his current account in my books. I don't know if I'm understandable there.
Yeah, I understand.
Okay, another person. Memory. You understand?
Yes.
Okay, Tandega, you have been, you come from far with me. I think you understand.
Yeah, understood. Thank
Okay.
you.
Now we're gonna increase the current account of P, the current account of S in P. So it means we're gonna increase from the 5,000 to 8,000. Then we're gonna do our journal, and then we say, now we are increasing the current account. So we say current account in P. So it means now the current account of S will also increase from 5,000 to 8,000. So it means the current account is increasing on the credit side. So now both of them, they have the current account, they have equal current account. So that will be the end of this journal. So now we're gonna do the journal for elimination, which will be our number 3. Okay. Now we do journal number 3. So it's the pro forma journal. So on the pro forma journal, as I said, I will only focus on the journals that they are not repetitive in nature. So we're gonna have the debit, and the credit. So the journal which will not be repetitive in nature, there is a journal for the preference share capital. So which that one comes up as a result of the analysis of shareholders for the preference shares. So now this will be the new journal that we have never done it before. So now we're gonna do the journal based on this information. So we have to record the share capital, we have to record the goodwill, we have to record the consideration paid. So it will also take the same pattern of the journals for the ordinary shares. So on the debit side, because now we are eliminating, we know that normally the share capital increase on the credit side, but because now we want to take them off, we're gonna say put them on a debit. Instead of say ordinary share capital, now it will be preference share capital. So the preference share capital, it was sitting on 50. So we're gonna put it on 50,000. So the goodwill is taken is not eliminated. Instead, it's taken further. Like it will be used in the asset of our consolidation. So it's still gonna increase on the debit side. We're not writing it off, because if we were writing it off, it was gonna go on the credit side. So the goodwill on the debit side as 5,000. So this goodwill of 5,000, it will be taken into our books as an asset. So we don't need to write it off. So it's going to increase on the debit side. Then we have the investment, which is the consideration we paid. Investment that we paid, I paid 25,000. However, whatever remaining, it will represent the non-controlling interest. Because when we say 55 minus 25, we remain with 30. So the 30 will represent the non-controlling. Non-controlling interest. Then we continue further. There is a journal that we need to account for based on the provision of the dividends that will be paid, because we pay the dividend of 5,000. So on our profit, we have the 38,000, then we less the 5,000, then it becomes the 38 minus the 5,000, then it becomes the 33,000, then the 33 multiplied by the 25%, which the 25% will present the NCI. So here it will be to record the portion of the profit based on the dividend. So we had the profit. If you check our analysis of shareholders, the one for ordinary, this one, we have 38,000 as our profit. We less the 5,000 for the preference shares paid. So we left with 33,000. So our 33,000 is going to be multiplied by 25% of the NCIs, because we want to know how much of that profit will represent the NCI. So it will be these values. So 9,500 minus 1,250 to give you the value. So that value comes as a result of 38,000 minus 5,000, then multiply by 25%. Or you can just use this 95,000 minus 1,250, which it will be the value to be used for the non-controlling interest in respect of the preference shareholders. So on our journal, we're gonna have NCI and controlling first, which it will be the one for statement of changes in equity, the SCI. Like when you're doing the statement of changes in equity, so that NCI, it will be this one on the debit. And then we're gonna also have a non-controlling on the SC, on the SFP. Non-controlling interest, the SFP part. SFP. Then which this comes as a result of these values. The 9,500 minus 1,250. The purpose is to account for the preference shares which they were declared. So we're going to have 8,250 and also the 8,250. So if you remember, normally we used to have this kind of a transaction, but initially it was not taking any account into the preference shares. It was just the profit, then multiplied by the minority part, then we record it here as a non-controlling interest. For example, if you can refer back to just slightly, let's go to learning number 8. You check the I'll give you the information now, just hold on. If you go to page 195 of your study guide, at the bottom there, we've got an amount of 10,740. So that 10,740 comes as a result of the profit only. It was profit for the year, then multiply by 20% of the NCI, which would give you the 10,740. But now, because in that case, there were no any preference dividend. But because now we have a preference dividend, we have to less our preference dividend from the profit first. We're going to say profit less preference dividend. So whatever remain multiplied by the percentage of NCI, then will be our journal. It's no longer straight like just profit for the year times minority interest or the NCI percentage. Is it making sense, especially when there is a preference shareholders involved? YV?
Following.
Okay, because I want you to understand between the information on page 195 versus the information on page, the current page that we are doing on page 21, the 213, 214. Yeah. I'm sorry, not 213, the page 210 and the 208. Mary, you are following?
Yes, sir. Thank you.
Okay. Tandaka and Memory.
Good, thank you.
Okay. Then we proceed. So that will be our NCI to be used here after taking into account the preference shareholders. Somebody must mute. Then we proceed further. Another journal that I have to show, which might be the complicated, the journal for the preference shares alone, which now it's gonna come from here. This part, the green one. So we do the preference, which it was the one based on the preference dividend paid. So we have the preference shares, which will be the non-controlling interest. Again, same information like this on the debit. So on the previous transaction, the one for the 8250, we were recording the narration. Let me do the narration. Sorry, the narration here, as seen in the study guide, we are recording the non-controlling interest in the profit after tax of S Limited after the provision of the preference dividend. You see, even on the narration, they mention after the provision of the preference dividend for the current year. So we assume that we made a provision that we're going to pay the preference dividends for the year ended 31 December. Remember, if when we are closing the book today, we're not going to pay the dividend today. Maybe they will be paid the following year, maybe after 3 months or 6 months. So it means we are raising a liability that next year, during the year, we have to pay the preference dividends of the prior year. Then we continue. We have another one, which will be the non-controlling interest. The NCI, non-controlling interest of the 3,000, which is based on this information, this one, of the 3,000 and another 3,000 on the credit side. But this one will also be the non-controlling interest interest. This one will be SFP, while the other one was the SCI. SCI. Then we proceed.
Sorry, sir.
Yes,
Is
YP.
Is that 3,000, if I understand it correctly, it's the NCI 60% that was left over from the preference share schedule up at the top?
Yes, yes, this one.
Okay. Yes, thank you.
You are right, it's the 60%. Remember, this side is 60%. 100% right. Okay. So the analysis of that journal is to record the non-controlling interest in the profit after tax for the current year and the 31 December. That is on the 60% portion of the NCI. Then we go to another journal, which this one will be the elimination. We used to have this kind of journal even though on the ordinary shares. So since the preference shares are declared, we declare the preference shares of, from the analysis of shareholders, we declare the preference shares of 5,000. So when subsidiary declare the preference of 5,000, so it means the parent, because the parent, remember the parent is owning this portion. This portion is the one for the parent. The parent owning this portion will now entitled to the 2,000 of the dividends. So it means he will receive the dividends of 2,000 and the non-controller will receive the dividends of 3,000. And then the total dividend declared was 5,000. Now you do the journal for this transaction, which it will be the elimination part. So we're gonna say on the debit side, because normally the dividend received, they become income. So now because we are eliminating them, we're gonna put them on the debit side because we are taking them out. So it will be the dividend received which is 2,000, because we as the parent, we receive the 2,000, and then our non-controlling, they receive 3,000. They receive an amount of 3,000. The total dividend declared was 5,000. So this is dividend paid or dividend declared. So this is in respect of the preference shares, because if you check from the on the retained earnings, the 10,000 shareholders, there were ordinary shareholders that declared. So this one, they have their own journal, which is the similar journal that we used to have, which that journal will be present. If you can see the journal for dividend received, then there's a journal for 3,000. So that journal of 7.5 is the one of the 10,000 portion, which is normally the journal that we used to have from the linear number 1 until now. Then another journal that I have to show, it will be the unrealized and the realized profit. So as at the year ending on 31 December 2007, P Limited sold P. What is selling here? The P Limited got all its inventory from S Limited. So it means at today, S Limited didn't sell the inventory yet. So it means you have an unrealized profit. On 31 December, the inventory of S Limited included the inventory to the value of 10,000 that had been purchased from P. So S Limited had an unrealized profit. So S Limited need to account that unrealized profit now. So the unrealized profit will be calculated as the value of the closed inventory as shown in the books or as shown on the transaction as 10,000. So it will be 10,000 plus the 3,000 of the inventory in transit, which now become the 13,000. Then 13,000 multiplied by 25 divided by 125. So it means that profit it needs to be eliminated, which it will be the 2,600. Then we do the elimination journal. We say the profit came as a result of the gross profit. On the debit it will be gross profit. And then there, what causes this gross profit? Remember, a closed inventory have an impact on the gross profit, because remember what from accounting one, when we were calculating gross profit, it was going to be the opening inventory plus purchases less closed inventory. So it means in this case, our gross profit is going to decrease by an amount of 2.6 for elimination purposes. So inventory is decreasing. So our 2.6 came as a result of 10,000 plus 3,000 equal 13,000 multiplied by 25 divided by 125. So we have 2600. So our 2600 will be recorded here as the elimination. I guess everyone understand that portion. So this will be the elimination, because this profit is not realized because the inventory is still sitting in the books of as limited. So it means it will be the unrealized profit in terms of P, because P will only realize this profit when S had sold those inventory to the people outside the group. So unrealized profit so it means the profit is no longer available in our consolidated. So we eliminate it. Then from there, it will be the current account. So the current account, remember, we recorded the current account here. So that current account recorded, now it needs to be eliminated. So we're going to eliminate the current account. So both of them, they have the equal current account. So it will be current account in P versus the current account in S. So the current account and the current account in S. So all of them, they will be equal the 8,000. So up to so far, any question?
Following, thanks.
Okay. So now we'll do the consolidation. So the consolidation in this case, they will be just simple because we're just consolidating whatever was not eliminated. So those one, I'm not going to draft them on Excel. We're going to just be interpreting whatever's in the books. So where there's a need of explanation, then I will just write. So we consolidate starting from the, normally when we do consolidation, we'll start from the statement of profit and loss. So we've got the profit before tax as referred in calculation 2. So we're going to take the profit before tax for P and S. So profit before tax of P and S, it was the one for P was 70,000 and the one for S was 58,000. So it's 70 and 58. So they say the ordinary dividend received from S. So when you go to analysis of shareholders, you can see that based on the ordinary dividend declared, S declared the dividend of 10,000. So P will be entitled to the 7.5. So that 7.5, initially it was an income, but because we are eliminating it, we put it in the bracket because we are taking it off. So we put 7,500 as minus, and then the preference dividend as limited declared the dividend of 5,000. So after declaring the dividend of that 5,000, then P was entitled to 2,000. So we minus that 2,000 entitlement. And then from there it will be the unrealized profit. So when we do the consolidations, P was supposed to realize a profit of 2,600, but because the inventory is not yet sold, so we're gonna minus the 2.6. But next year, when the inventory was sold, then we're gonna add it back 2.6 in the consolidation. So now we minus the 2.6 here because the inventory is not yet sold because it's an unrealized profit. But if it was a realized profit, it was gonna be added back. So 70 plus 50 minus 7.5 minus 2,000 minus 2,600, they give you 115,900. So that 115,900 going to represent your profit before tax. So the income tax expense, it will be the one for the parent plus the one for subsidiary. Then they give you the 45,000. So yeah, 115,900 plus minus the 45,000, they give you 70,900. Then 70,900 will represent your profit for the year, or the total comprehensive income for the year. So now you have to apportion it. So when you apportion it, you're gonna say the owners of the parent. So the owners of the parent, it will be the 70,900, that one. You minus the 11,250. The 11,250 came as a result of one. You have the amount that you used on the current year for analysis shareholders of the ordinary shares. The 9.5 minus 1,250, it will be equal. So let's do it here. It will be the 9,500 minus 1,250, which equals the 8,250. Then you come back. Now you have the 3,000. The 3,000 comes as a result of the attributable to the profit, the one on the analysis of shareholders of the preference shares. This one, that 3,000, this one. So now you're gonna say plus the 3,000 here, plus 3,000, which now equal 11,250. So that's how to arrive to that 11,250. I guess everyone understands that portion. If you need clarity, please notify me before I pass. So I believe everyone understands how to arrive to that 11,250. It's because we are taking to two profit for the, like the portion for the profit, this one, versus the one attributable to the profit, this portion, this one. So you add them all together, they are both on positive, so they're gonna increase the value. But if this one was minus in some other case, which there is very rare that this one gonna be on minus, so you were gonna put it on negative. Because the reason it's positive is because there was a positive figure used to distribute the preference dividends. Then you are 7,900 minus 11,250, it's gonna give you the 59,650. So the 59,650 plus 11,250, it give you the 70,900. So here they just elaborated the same calculation that I did. This one, they just show you how did they arrive to the 11,250. Then we are done with the statement of the thingy of the profit and loss. Now we have to do the statement of the changes in equity. So the statement of change in equity, the preference, the ordinary shares of the subsidiary, they are eliminated. So we're going to have balance on 1 January 2007 on the statement of change in equity on the share capital will be the 200,000. Page 208, it will be 200,000 share capital. Then the retained earnings, they said is 24,000, which 24,000 was the one for the parent as the balance at the beginning of the year. Then we add it with the 3,750. The 3,750 comes as a result of the 75% on the retained earnings since acquisition, which is this one. Then you add it all together. Then they give you the 27,750. That will be the balance at the beginning. Then for the retained earnings purposes, so the 200 plus the 2750, they give you 22750. Then we go to the profit for the year under the column for retained earnings. The profit for the year is now sitting on 59,560, which comes from the statement of change, the statement of profit and loss, the consolidated one. So you're gonna take that amount which is attributable to the owners of the parent. You're gonna use it as your profit for the year in the statement of changes in equity. Then the dividend paid for the ordinary of 15,000. That's one that's straight from the retained earnings, the pre-adjustment statement of changes in equity under the retained earnings column. For P Limited, there was a dividend paid of 15,000. The one for 10,000 is now eliminated because we offset it off against on the elimination part when we were doing our journals. So the non-controlling interest will be anything that is non-controlling. The 68,500, it comes as a result of adding, let's see, it will be from the 28 plus 250. It comes as a result, like if you check on the 37,250 plus 1,250, and then you add with the 30,000, the 30,000 from the analysis, the one of the preference shares. Now they're gonna give you that amount of 68,500. So it will be this part. It will be this 30,000, the 30, this side, plus this side, the one of this portion, and the 1,250. Normally to be, you can follow it more on journal on page 220, the one for journal. There's 37,250, which is this one, plus the 1,250, which is this one, then plus the 30,000 from the analysis of the preference. So it's where to arrive on the 68,500. Then the profit for the year is the one of our non-controlling, which is already calculated on the statement of profit and loss. You add with 11,250, then you less the dividend paid of 5,500. So the dividend paid of 5,500, they represented by on the ordinary, the 2,005. So it will be the 2,500 of the ordinary dividend plus the 3,000 of the preference shares. So they will give you the 5,500 on the non-controlling part. So now you do the total equity, which is that addition of all those columns. Anyone who wanted clarity on the statement of changes in equity, please notify me. YV?
So you moved very fast, but I'll go and do it by myself, and then I'll ask questions on the WhatsApp group.
Okay, please do. Mary? I can't hear you, Mary.
No, I'm fine, sir. Thanks.
Okay, Tandaka.
I'm fine, thank you.
We lost our 2 students. I don't know if maybe student to network or what. Then from there, we're gonna do the last part, which will be the consolidations of the statement of financial position. So that one is just straightforward because it's from the equity side is based on the statement of change in equity. Then from the asset section is just the integration of the two things or so. So on the PPE, we have the 100,000 of the PPE of land and building at cost plus the 80,000, then plus that 40,000, the one for revaluation, then plus the 40,000 of the plant carrying amount and the 20,000 of the plant carrying amount. So when you add them all together, they will give you as the amount of 280,000. So now is the goodwill. The goodwill is the goodwill from the ordinary analysis plus the goodwill from the preference analysis. When you add them all together, they give you 13,250. Now we go to the current assets, which it will be the inventory of the 25,000, which it was the one for parent, plus the 60,000 of the subsidiary, then plus the 3,000 of the inventory in transit. And then minus the profit. So the 13,000 times 25 divided by 125 is the profit from the one calculated here. It will be this portion. Then when you add all those and minus the profit, they'll give you 85,400. Then trade and other receivable, just straightforward as the 20,000 from the parent plus the 48,000 from the subsidiary, then they give you the 68,000. So now we go to the equity part. The share capital represent the 200,000 from the share capital on the statement of change in equity in page 208. So the retained earnings is 72,400. On my study guide is written somewhere somehow. I don't know on your side. On your side is written as 72, and then at the bottom is 400. So it should be 72,400 as one line. So when you add them all together, it will be 272,400. Then the non-controlling, it will be the 44,250 from the total analysis of the ordinary plus the 30,000 from the total analysis of the 30,000 of the preference shares. We are focusing on the NCIs. So the 44,250 on the total for NCI plus 30,000 on the total for NCI on the ordinary and versus the one for preference. When you add them all together, they give you the value of 74,250. So our 272,400 plus the 74,250, they will give us the 346,650. So the current liabilities, the current liability will be represented by only one thing, which will be the one given, because remember our current account is eliminated. So it will be the 84 plus 16, which they give you the total of 100,000. So our 34650 plus 100,000, then they give you the 44,650. That will be the end of the statement of financial position. Anyone who have a question up to so far? Okay, seems like no one have a question. So the next example on page, starting from page 211, it will be the treatment of preference dividends in the subsidiary. So now, like in the example, the one we just dealt one, like this, it was the subsidiary part, but he declared the dividend, or he was making a provision that you're gonna declare the dividend. So on the next example, now the preference dividends, they are in areas, like he didn't pay the certain preference dividend, maybe for the last year or the prior years, he didn't declare those dividends. Now we want to know how we're gonna account them when we made the declaration. But I'm not gonna do it now because it's nicer when you do the example and you finish it in one lesson. rather than do it in half-half, because you can see it will run from page 212, 213, 214, and 215 up to 217. So it will, I mean, up to 216. It will be better if we reserve it for the next lesson. However, I will recommend you that you do this example on 211 on your own. Just first do it. I'm still going to repeat it in the class though. Do the example 211 and do example on page 211 and do example on page 216, and then also I don't know if you'll get a chance though with the example 3, because the next class it will be on the 2nd. I'm not gonna have a class next week, the week of the 25th. Not gonna have a class, so you still have time that you can use to revisit this learning unit, so that at least when we meet again on the 2nd, it's either we tackle maybe the first hour we tackle all these 3 examples in a fast-paced manner, and then we'll also tackle question 1. I don't know if we can able to do that, because the next week there is no class, so it means they will have almost 2 weeks of tackling the learning number 9 until we meet on the 2nd of October. But however, we can still communicate via WhatsApp, even though we won't be meeting, but we can still communicate on WhatsApp. Anyone who wants the clarity?
I understand, thanks.
Okay. Tandeka.
Understood. Thank you, Mr. Miller.
Okay, and Mary.
I understand, sir. Thanks.
Okay, then up to so far, how is the content of this module on your side when you are doing it alone on your own pace? Unless if you reserve it for the last minutes when you be writing the exam. How is it so far, this module?
I'm very late in the game, so I can't really comment.
Okay, Mary.
It's not that bad. It's just that you have to understand
Okay,
the content actually.
and if you can note, especially for UYV, since you are not yet in the game, this module is more about repetition. So for your side, because you have just started now or recently, I will advise you to do learning unit number 7, because the learning number 7 is the continuation of whatever happened in learning number 1, 2, 3, 4, 5, and 6. So just do learning number 7. You can start from the beginning until you reach the end of it, and do it with understanding. And then from learning number 7, jump to learning number 9, and also do it with understanding. Because learning number 8 is just the ordinary shares where they are in areas, where they are not paid, or you are making a provision to pay them, or they are fully declared.
Okay, well noted,
Yeah.
thank you.
Okay, so because from now on we are left with how many hours? 8. It will be 2 hours on the 2nd, 2 hours on the 9, 2 hours on the 16, and 2 hours on the 13. So we are left with 8 hours though. Even if, let's suppose we were meeting on the 25, it means I was gonna teach on the 25, the 2nd, the 9, and the 16. Unfortunately, I was not gonna be with you on the 23rd because my hours will be exhausted, because we were given a total of 30 hours. So from that 30 hours given, I'm left with 8 hours. So that 8 hours I will utilize it on the 2nd, the 9, the 16, and the 23. I think it makes sense. Yeah. If there is no comment, then that will be the end of this session. Mary, YV, I will add you into the WhatsApp so that we can have access to communicate with us.
Thank you, Mr. Mulape. Also, the recordings, the history recordings, do we have an idea when they will be available yet?
And unfortunately, now Bulan is not on the line. I was gonna ask her, because since I'm not running the class from UNISA, so I'm not in the campus, so I'm only relying with them via the email. Up to so far, I don't have access to the recordings. Last week, someone was trying to access the recordings, and then she said it wants something email. It says the email is incorrect, so I don't know what was the story, but I hope I will get more information. Then I will communicate it via WhatsApp. In the meantime, I will try my best to get an idea of what's happening with the recordings, because I also want to know them. I also want to hear them.
Okay, thank you.
Okay, that's it. That's the end of our session for today. Then we can adjourn the meeting.
Thanks very much.
Thank you.
Thank you very much, Mr. Mlepo.
We'll meet again on the 2nd, but communication via WhatsApp is allowed. Don't say because I said we will meet on the 2nd, then we are not allowed to communicate. You can WhatsApp, then I will respond. Mary, I didn't respond to you that time because I was so confused with your pages.
Noted, thank you, sir.
Okay. Okay, Pulan is on the line. YV?
Yeah.
Pulan is on the line. Please ask that question, the one for the recordings.
Miss Polani, hi.
Thank you, sir.
Is there any ETA on when the recordings will be available yet, please? Miss Polani?
Good afternoon. Yes,
Hi.
Greg will share the recordings with you after they've been audited, because after the class we send them for auditing, and then she will share the recordings with you and the tutor.
But
Okay,
up to
so
so
all
far,
the history ones.
Up to so far, we're still waiting for the recordings from the lesson number 1. I don't even have it. And up
Is
to
it?
so far, the classes, the module is about to be written in 4 weeks' time.
I would then, Mr. Mlep, could you please send an email to Craig and CC me?
Okay.
Yeah, send an email to Craig and Mercado and CC me. Or
Okay.
Mercado is on leave. Just send it to Craig and CC me.
Okay.
Okay.
Okay,
Thank
Pulane,
you.
I don't know if you're able to hear that. Next week, I want to have a class for this module. The class will resume again on the 2nd. Because now we are left with 8 hours. So it will be the 2nd, and then the 9, the 16, and then the 23rd, then done. So that will be equate to the 8 hours left.
Okay. Yes.
Because okay, I'm listening.
Okay, carry on.
Okay, I was saying I want to use this 8 hours so that at least the last Saturday before exam, I want to be with them, because normally I know they will be having a lot of questions that day. So it will be bad for me to have the last class on the 18th while they are writing on the 23rd.
Oh, that makes sense. In
Yeah.
any case, again, please send an email to Craig and explain to Craig that you want to have a class and
No,
all
he already knows.
Oh, okay, no, good,
Yeah.
super.
Okay.
Super. Okay.
Okay.
Can I then stop the recordings of today's class?
Yes.
Okay. Thank you, colleagues, and have a lovely weekend.
You too, have yourself a lovely one, and to all students, enjoy your studying while preparing for the examinations.
Thank you.